One of the most important reasons for keeping a detailed financial statement is to be able to ascertain the growth of any business. Every business venture is aimed at making profits, and knowing the position of a business financial statement at every point in time is a great help in every decision-making process relating to the business. However, a larger percentage of businesses have no understanding of the basics of financial position indicators. How do you identify when a business starts to make profit, or even when is a business set to have broken even? Or do you even know that in reality a business could be running at a loss and still be in business, but the moment a business is out of cash, then it has gone bankrupt? So, when does a business go bankrupt? The cash flow statement section will give you an insight into this. Another critical business financial driver reality is tax. Without the understanding of how it works, you may be shooting yourself in the leg and ripping yourself of your business profit. What do I mean by shooting yourself in the leg? Remember our story of Bola, the fashion designer? You'll recall that Bola is set to generate 100,000 naira monthly. Now she's in a new home and in a new store as well, and has made some adjustment to her financial statement based on what she had experienced from moving to her new home. So let's look into the former and the new financial statement. In the former, her profit reading was at 20,000 naira. While in the new statement, which now includes the cost of rent and profits, it is now reduced to 10,000 naira. Now, if Bola is to pay a company tax of 5% on this profit made, that will amount to 500 naira. But because Bola has not been detailed in keeping her business finance properly, she may just have shot herself in the leg by paying the 500 naira as tax. Assuming that Bola made a call to a customer that cost just 5 naira, that is, buying a recharge card of 5 naira to make a call, and she didn't think it really mattered to record this 5 naira in her record book, this in real time would have brought the profit she's making to 9,995, because this 5 naira is an expense, meaning that she ought to pay a tax of 499 naira 75 kobo. But because she did not record this 5 naira in her expenditure and cannot prove these expenses, she has to pay the tax of 500 rather than 499.75 kobo, making her lose a few kobo to the government. Imagine that you pile up 1,000 units of these small expenses. How much would they have affected your business finance? This tiny amount can affect the value or the net worth of your company. It can affect the payroll, it can affect investors' funding, affect the dividends, and even the shares of stock valuation and declarations. So, even if you are exempted from paying tax now, it can affect the other aspects of your business. The golden rule in business finance here is to record every little transaction, the income and expenditure, to the latter in full detail. Now, if you have not been able to effectively initiate this in your personal finance as discussed in Module 1, this may prove a little difficult, except you may get the services of a financial consultant that manages your finance. So then, how do we keep detailed business financial records? We will focus on the 3 basic records for the purpose of this startup course. But as your business grows, you must continue to learn and be aware of advanced financial details by learning from experts in the field of business finance. The 3 basic records will be the cash flow record, which is known as the funds flow, the profit and loss statement, which is also known as the income statement, and your balance sheet. So let us start with the cash flow statement.